Open. Blackstone is moving to take its data center REIT public, with Phoenix as a named anchor market. That headline ran through the business press as a capital market story, another big alternative manager monetizing an infrastructure bet. That's the wrong read. Here's what it actually is. It's Blackstone telling you the private market arbitrage window is closing. When a platform of that scale decides public investors should now set the price, it means they believe public market multiples will meet or exceed what they can extract from further private accumulation. They are not doing you a favor by offering shares. They are locking in basis and transferring the compression risk to the next buyer, who, in a listed REIT structure, is the public market. The operators and co-investors watching this from the sidelines, thinking they have another cycle to decide whether data center real estate belongs in their portfolio, are going to find that Blackstone already holds the best position sites in Phoenix, already has lawyers on the secondary markets behind Phoenix, and the private market discount to replacement cost that made these deals work 2 years ago has mostly been arbitraged away. Not entirely, there are still lanes, but they are narrowing in real time, and this IPO filing is the clearest timestamp we have on when the clock moved. The data layer. Let's put numbers on the table. QT's Realty was taken private by Blackstone in 2021 for approximately $10 billion, or roughly 27 times EBITDA at the time, a premium that looked aggressive to some observers. Today, with AI-driven demand having repriced the sector, that multiple looks like the entry, not the exit. CyrusOne was taken private by KKR and Global Infrastructure Partners in late 2021 at a similar valuation. Both deals happened when colocation demand was the primary driver. The repricing since has been fueled by hyperscaler and AI build-out demand, which is a structurally different demand profile. Longer lease terms, larger footprints, higher power density requirements. On the public side, Equinix trades at approximately 26-28 times forward EBITDA. Digital Realty is in the 22-24 times range. Iron Mountain's data center segment is growing its contribution and commands a premium to its legacy storage multiple. These are the comps Blackstone's bankers are using to justify a public offering, and they suggest that if Blackstone's vehicle prices inside those multiples at IPO, it has room to run on multiple expansion alone, before any NOI growth. Transaction pricing on powered land and built data center assets has moved significantly. Per JLL's 2024 Data Center Investment Outlook, primary market cap rates for stabilized hyperscale assets compressed into the 5.0 to 5.5% range, and in some Phoenix submarkets, below that for assets with long-term leases to investment-grade tenants. That's not a typo. Sub 5.5 cap on industrial-adjacent real estate, justified by 10 to 15-year and leases with credit-worthy hyperscalers. CBRE's 2024 North American Data Center Trends Report put Phoenix vacancy for powered shale space at under 3%, effectively zero available capacity in the near term. On the construction side, Turner Construction and Mortenson have both published cost data indicating fully built-out hyperscale data centers are running $12.16 million per megawatt all-in, depending on power tier and redundancy specs. That's replacement cost. The question for any buyer today is, what am I paying relative to that number? In primary markets, assets are trading at or above replacement cost. In secondary markets, and I'll come back to this, you can still find basis inside replacement cost, but that window is compressing too. Power is the real constraint variable right now, and Real Capital Analytics flagged it explicitly in their Q3 2024 data center transaction summary. Deals are pricing on megawatt capacity, not on square footage. The metric that matters is cost per MW of available, contracted, or pipeline power, not rent per square foot. Brokers who bring me data center opportunities and quote per square foot pricing without a power spec are telling me they don't understand the asset, the mechanism. Why is the compression happening now, and why is the Blackstone IPO the catalyst rather than just a coincidence? Three forces are converging simultaneously. First, hyperscaler capex is not slowing. Microsoft, Google, Amazon, and Meta have all guided to sustained or increasing data center capex through 2025 and into 2026. Microsoft alone has publicly committed to over $80 billion in data center investment in fiscal 2025. That demand is not speculative, it is contracted. Hyperscalers are signing 10 to 20-year leases before a foundation is poured, because the alternative is being capacity constrained during the most competitively critical infrastructure build-out in the history of the technology industry. Second, power grid interconnection timelines are extending, not contracting. PJM's interconnection queue as of late 2024 had a multi-year backlog. ERCOT in Texas is under similar pressure. In Arizona, APS and SRP have both indicated that large industrial power customers, including data centers, face 3 to 5 year timelines for new service agreements above certain megawatt thresholds. What that means for deal flow: the asset that has existing power, or has a permitted substation position, or has a utility easement in place, is worth a structurally different price than vacant land with the same zoning. Power certainty is the premium. New entrants without existing utility relationships cannot replicate it quickly. Third, and this is the mechanism most people underweight, institutional capital is beginning to chase this sector in earnest. Blackstone going public creates a comparable, a benchmark, a reference asset for allocators who were previously unable to underwrite data center real estate within their mandate because there was no listed proxy. Once the REIT is public and trading, every pension, sovereign wealth fund, and endowment that missed the private market window now has a public vehicle to allocate against, and that public vehicle will suck liquidity out of private deal flow by setting a floor on seller expectations. Sellers who were willing to transact at a private discount 6 months ago will now point to Blackstone's public multiple and hold for a higher number. Where mid-market capital fits. This does not mean mid-market capital is shut out. It means the strategy has to shift. The hyperscale primary markets, Northern Virginia, Phoenix, Dallas, Chicago, Silicon Valley, are largely competed out at the sub-$100 million check size. You are not buying a stabilized 40 megawatts campus in Ashburn at a basis that works with private market targets. Those assets are institutional, the cap rates reflect it, and the deal process is run by Eastal or CBRE with 5 qualified bidders minimum. Where there is still room: 1. Powered land in secondary and tertiary markets. Markets like Reno, Boise, Columbus, San Antonio, Tulsa, and Huntsville are absorbing spillover demand from saturated primaries. Power is more available, utility relationships are more accessible, and land basis is dramatically lower. The play is acquiring permitted, power-adjacent land, ideally with a utility easement or a transmission upgrade in the pipeline, and either developing to core or selling to a larger operator who needs the runway. Deal sizes in this lane are $5 million to $40 million, which is exactly where I can move without competing against Blackstone's deployment vehicle. 2. Fiber-ready industrial conversion. There is a category of second-generation industrial, 2000s era flex and light industrial with above-average power infrastructure, typically built for manufacturing or distribution, that can be repositioned as edge or colocation data center product. The cap stack on a conversion is different from ground up, lower construction risk, faster to revenue, and you're buying at industrial pricing rather than data center pricing. The embedded arbitrage is the delta between those two price points. 3. GP stakes and sub-institutional operators. There are regional data center operators running 5 to -30 megawatts portfolios who have real contracts, real tenants, real recurring revenue, and no institutional sponsorship. They're too small for Blackstone, too specialized for a generalist PE fund, and they need growth capital or a JV partner to execute on their pipeline. A minority GP stake with co-investment rights on future development is a structure I look at closely in this category. Counter positions and risks. I don't want to strawman the bear case, because there are legitimate concerns. The demand concentration risk is real. A meaningful percentage of hyperscale leasing is coming from 4 tenants: Microsoft, Google, Amazon, Meta. If any of them pull back capex guidance, the development pipeline in secondary markets gets stranded quickly. We saw a version of this with a WeWork shock in office coworking. Demand looked durable right up until it didn't. AI infrastructure capex is currently running ahead of monetized AI revenue, and that gap is worth watching. Power cost escalation is also underpriced in many development pro formas. Electricity rates in Arizona have increased, and the utility investment required to serve large data centers is increasingly being passed back to the customer through demand charges and infrastructure contributions. Underwriting power costs at today's rates on a 15-year hold is an assumption worth stress testing, and the public REIT structure itself introduces a risk for private deal flow that cuts both ways. Yes, it creates a comp, but it also creates a mark-to-market. If Blackstone's REIT trades down post-IPO, as many data center and tech-adjacent REITs did in 2022, it resets seller expectations downward too. That could actually create a buy window rather than close one. The 2022 digital REIT correction compressed digital realty from roughly 30 times to under 20 times forward EBITDA in 12 months. I'm not predicting that, but I'm not ignoring the precedent. The position I'm taking. Concretely, here's what I'm doing. I'm actively evaluating powered land positions in 2 Phoenix submarkets, specifically west of the I-10 corridor where APS infrastructure is more accessible than in the core Chandler Mesa data center cluster. The ask pricing on some of these parcels is still inside replacement cost by a meaningful margin, and with the right entitlements and a utility pre-application in place, that basis pencils for either a merchant development exit or a JV with an operator who needs shovel-ready supply. I'm also looking at a conversion opportunity, second-generation light industrial in a mid-tier Texas market, 18 megawatts of available utility power already permitted, asking at industrial cap rate pricing, with a colocation operator ready to anchor 40% of the space on a 7-year lease. That's the kind of structure where the pricing mechanism is still based on the building's prior use, not its highest and best use. On the GP stake side, I'm in conversation with 2 regional operators, one in the Mountain West, one in the Southeast, both sub-30 megawatts portfolio, both with development pipelines they can't fully capitalize without a structured equity partner. Those conversations are at a stage where if you're a broker who knows similar operators looking for that kind of partner, I want to hear about it. Close. Blackstone going public with a data center REIT is a timestamp, not just a transaction. It marks the moment when the largest alternative capital platform in the world decided that public market pricing is ready to meet private market basis, and that means the arbitrage available to operators moving quietly in secondary markets, powered land, and sub-institutional GP stakes has a shorter runway than it did 6 months ago. The lane is still open, but it requires moving on specific structures, in specific submarkets, with a power-first underwriting lens. If you're a broker with powered land, fiber-ready industrial, a GP stake in a regional operator, or a co-investment alongside a credentialed data center developer, bring me something specific. I'm not looking for decks, I'm looking for deals. DM me at @DeBrody Official. I route every inquiry personally.